Welcome back, it's JWalter here. Fannie Mae just downgraded their economic forecast as well as their housing market forecast for 2022 into 2023. In my previous video, I went over their housing market forecast over the next couple of years, but in today's video, I'm going to share their economic forecast as well as more details regarding their housing market forecast that were both downgraded from their previous forecast from last month. So in today's video, I'm going to take a deep dive into that. Let's share my screen with you right now. This is from Fannie Mae. They just announced this on the 19th of May. It says rapidly rising rates and persistent inflation are further softening their economic outlook. Persistent inflation, rising interest rates, and a slowdown of global economic growth are the primary contributing factors to updating expectations that full year 2022 real GDP will grow at the reduced rate of 1.3%, and that is 0.8 percentage points less than previously predicted. In other words, they are saying that they're going to be updating their expectations. Another word is that they are actually downgrading their expectations for economic growth and also their housing market in 2022 and 2023. And by the way, this is from Fannie Mae's Economic and Strategic Research Group, or their ESR group. It says here they believe that the Fed's efforts to curtail inflation by tightening monetary policy are unlikely to result in a so-called soft landing. Expectations for a modest recession beginning in the second half of 2023 remain unchanged. In their previous forecast, they were also calling for a recession in the second half of 2023 as well. So that remains unchanged. But here's what has changed though. It says, though the risks of such a contraction occurring sooner have increased. In other words, we have a risk that we're going to be seeing a recession sooner than that. And this is because of elevated inflation and a rapidly rising rate environment. And as I mentioned in my previous video, Fannie Mae is also predicting a slowdown in home sales for the second and third quarters of 2022 and also for 2023 as well. And ultimately a large deceleration in home price growth. I didn't go over this much in my previous video, so I want to kind of touch on that in today's video. They have what's called the Fannie Mae HPI. A lot of these corporations have an index based on home prices. So this is their home price index. And this is a percent change in their index year over year by quarter. So for 2021, for Q4 2021, their percent change in their HPI increased by 19.2%. For Q1 of 2022, it reached an all-time record high at 19.8%. They have not seen levels that high in over 40 years. However, this gray shaded area here is their forecast. So for Q2 of 2022, they are forecasting for their HPI to only increase by 15.9% compared to 1 year ago. That's a decrease obviously from the all-time record highs of 19.8% in Q1. And as you can see here, for every quarter thereafter, they are downgrading their forecast. So when we get to Q4 2023, it's only going to be a 3.2% increase in home prices compared to 19.8% in Q1 2022. So overall in 2021, we had a 19.2% increase in their HPI, but they're calling for only a 10.8% increase in 2022. And look at that, a 3.2% increase in 2023. I mean, really big difference when we look at 2021, an increase by 19% and only an increase by 3.2% in 2023. They also downgraded their expectations for total home sales as well. So 2022, they were expecting that total home sales, that would include single family and also condos and co-ops, to go down by 11.1%, and in 2023 to go down an additional 11.6%. They go on to say the following in this report here. Financial conditions have tightened significantly and the economy is slowing faster than previously expected. And what they're basically saying here is that the Fed is going to have a difficult path to get inflation at their target range of 2% in a timely manner. They also downgraded both their GDP forecast as well as their forecast for home sales and mortgage originations in 2022 and 2023. So they now project real GDP growth measured on a Q4 to Q4 basis to be only 1.3% in 2022, down from the previous forecast of 2.1%. So the previous forecast was calling for a 2.1% increase. Now they have been downgrading that forecast to 1.3%. Also, they are forecasting for GDP to decline in 2023 by 0.1%, and that's unchanged from the previous forecast. It goes on to say here that in 2022, in the first quarter, GDP came in weaker than expected. It actually decreased by 1.4% on an annualized basis, and that's the first decrease in GDP since 2020. However, persistent inflation, which is increasingly eating into consumer spending power, along with rising interest rates and weakening global growth, led us to project our modest growth for the remainder of the year. Therefore, they are maintaining their call for a recession to occur in the second half of 2023, as we continue to believe that the tightening of monetary policy aimed at curtailing inflation will ultimately tip the economy into a contraction, in other words, a recession. However, the risk of a recession becoming sooner are growing as inflation remains persistent, financial markets conditions tighten, and growth in Europe and China weakens further. It goes on to say here that the first quarter of 2022 was obviously the first contraction of GDP since the outbreak of COVID-19 in 2020. However, they do not believe this is going to be the start of a recession because we have strong employment growth, and also they are projecting GDP growth to turn positive again in Q2 of 2022. So here's one alarming trend we're seeing right now, and that is that consumers overall are turning to credit in order to buy goods and services right now. So right now, as you can see here, elevated levels compared to pre-COVID, much higher levels compared to pre-COVID that we're seeing right here. And by the way, this is the percent change in consumer spending using credit cards, for example here. It says a surge in credit card balances over the past 2 months suggests that many consumers are increasingly stressed by the high inflation and are maintaining consumption growth by turning to credit. So in other words, they're not decreasing spending. Instead, they're going to purchase goods and services using credit cards, for example. And it says here this trend is unsustainable or not sustainable. Therefore, without some sustained price relief on durable goods, energy, and food in the coming quarters, such that real income growth can return to positive territory, the possibility of a late 2022 recession becomes more likely. In other words, what they're saying here is that if the Fed does not get inflation under control such that people's wage gains are not being absorbed by inflation, then we could see a late 2022 recession. Fannie Mae also said that they expect the Fed to continue tightening in the coming months at 50 basis point increments as long as the labor market does not show signs of weakening. So what they're referring to, of course, is the Fed controlling the federal funds rate. So as you guys all know, the Fed increased the federal funds rate by 50 basis points in their last meeting, and they increased it by 25 basis points in their previous meeting. As you can see here, here's the federal funds rate over the last 1 year. So at their March meeting this year, they increased the federal funds rate by 25 basis points. And as you guys all know, they increased the federal funds rate by 50 basis points in their meeting in May. And what the street is forecasting right now is for a 50 basis point increase in the federal funds rate. And that's by a probability of 78.6% in their next meeting, which meets in 3 weeks and 5 days from the time of this video, In regards to their housing market forecast, they said a slowdown in home sales is also not entirely about diminished purchasing power. In other words, because of record high home prices and of course rising mortgage rates, that's obviously decreasing buyers' purchasing power. So it says it's not all about that because of course, as I showed you guys, they are forecasting for home sales to decrease by 11% in 2022 and also 11% again in 2023. It says by their estimation, about 85% of current outstanding mortgage borrowers have rates at least 100 basis points below current rates. In other words, approximately 85% of homeowners have mortgage rates right now of at least 1 percentage point less than current rates. So right now, rates are approximately 5.5%. So they're saying approximately 85% of people right now have rates of less than 4.5%. And it says here a household moving even to a similarly priced house would experience a much higher mortgage payment, discouraging such a choice. In other words, if someone's going to be selling their house and buying the same price house in a different neighborhood, for example, their mortgage payment would increase greatly because home prices have increased greatly. And of course, mortgage rates have increased greatly as well. This is true for myself because if I were to sell my house and move to a house next door that's basically the same size, then my mortgage payment would approximately double because I'm locked in at 2.6% and mortgage rates right now at around 5.5%. Therefore, one would assume people like me would not want to sell their house and forego or get rid of their 2.6% mortgage rate, given the fact that rates have increased. However, it says our analysis of new listings of homes put on the market shows a 8.4% decrease in April on a year-over-year basis of new listings hitting the market. That's down from a 3.8% decline in March, suggesting that this disincentive may now be on the minds of many existing homeowners. What I found to be very interesting is that here's their graphic showing new listings compared to now to 2021 through 2019. What I found to be very interesting is that this kind of resembles a Redfin's graphic. So they're saying that we're seeing a 8.4% decrease in new listings in April at the time of this forecast here. However, it's not updated though, because have a look at this. Here's the most recent data we have. This is new listings according to Redfin. So if you look at only April's data, which would basically end in around here, because this is a 5.3% decrease in 2022 for the 4 weeks ending May 1st. So that's a decrease by 5.3% compared to 1 year ago. Pretty similar when you're looking at the rate here at 8.4% decrease in April on a year-over-year basis. However, ever since then, new listings have been increasing to my surprise, really, to be honest with you guys. For the 4 weeks ending May 15th, they're basically flat compared to 2021 and also compared to 2019. So right now, we basically have the same number of new listings compared to 2021 and also 2019. And this would suggest that more people are listing their houses for sale in order to get all their equity out of their houses based on favorable conditions for home sellers. So in any case, it goes to show that data can change. So yes, it was also my opinion that we're going to be seeing a lot of people who are don't have the motivation to get their houses listed for sale because they have very low rates. And that's what basically Fannie Mae is saying right here. However, the most recent data right now is basically suggesting otherwise because the number of new listings has been increasing greatly really ever since the middle of April. It goes on to say in this report from Fannie Mae that there are some early signs or early indicators that the housing market activity may be slowing. In other words, home buying activity may be slowing. So Redfin reported that 16.1% of listings, those are active listings, saw price drops. In other words, they reduced their asking price over the 4 weeks ending May 8th. That's up from 11.7% from 1 month ago and 9.2% from 1 year ago. Meanwhile, it says here there are reports from home builders that buyers are canceling their contracts, and the April Home Builders Sentiment Survey, or the Sentiment Index, reached actually a 2-year low. This is according to the National Association of Home Builders. They reported a sizable drop in the prospective homebuyer foot traffic metric. Also, according to Fannie Mae's Home Purchase Sentiment Index, they registered a new record low of the respondents who believe it's a good time to buy a house. Here's something you should definitely be aware of because they are stating here that home prices relative to family income levels are now more deviated from the historical norm than the peak experienced in 2006. So in other words, home prices have been increasing at far greater rates than household income increases, and this deviation is beyond the historical norm and beyond the peak experienced in 2006. And they believe this points to the unsustainability of current house prices. And this is relative to longer run fundamentals, and with rising mortgage rates, this suggests strong downward pressure on continued home price appreciation. Therefore, their latest quarterly home price forecast is only calling for a 10.8% increase by Q4 2022 compared to 20% in Q1 of this year. And also it's going to be decreasing to 3.2% by the end of 2023. It also says here they believe there is still some downside risk to their forecast here. Their next update will be in July, and this is because of rising mortgage rates as well. This says, given the significant variation in regional home price growth, in other words, every housing market's different, a forecast for 3.2% increase, again, by Q4 of 2023, implies that some regions will likely experience price declines. Something else you should be aware of is that they are not anticipating a financial crisis like 2008, for example, because they're saying that credit quality is much better. In other words, people buying houses right now have much higher credit scores or FICO scores. That's actually true. Also, loan servicers are also better equipped right now to manage loan modifications and other workout strategies, for example, forbearance programs, for example. Also, they still believe there's still an underlying lack of housing supply relative to demand, and vacancy rates remain very low for rental properties. And speculative overbuilding is not present like it was in many regions in 2008. So before I wrap this video up, I want to talk about new home construction very quickly, because they talk about home builders still facing considerable backlogs. But here's a key stat here, because they say that gross margins by home builders still remains relatively high. This suggests that they may have room to offer concessions and discounts to maintain sales volumes going forward. So basically, over the past year and a half, it's been very challenging for home buyers to buy brand new houses. In many markets, like my market, for example, you have to get on a wait list in order to even get a chance to buy a brand new house. This is because they don't have enough dirt lots in order to sell to home buyers. So what they're saying right here, though, is that if demand decreases enough, this could be a good sign for home buyers, because there's such a high gross margin that they're working on, or they're operating on right now, is that if they have a decrease in home buying demand, they do have room for concessions and discounts to give to home buyers. So back in, I don't know, it's 5 years ago, it was very common for home builders to offer incentives like free upgrades, for example. But over the past year and a half, we have not seen that, because builders have a influx of housing demand. But interesting to see here that if we do have a decrease, we could see a chance for home buyers to get some discounts or concessions from home builders. So comment below with your biggest takeaways from today's video. Also, if you got any value out of today's video whatsoever, then please hit the like button. I greatly appreciate that. Hope you have an awesome day. Look forward to seeing you on the next video.